Last week, I was scrolling through Reddit when a post suddenly caught my attention. A trader showed how he had already made $9,000 this month trading prop firm accounts. And he's not flashing any Lamborghini or any secret indicator. He's just executing one very simple strategy every single day. The 5-minute opening range breakout on the New York session. So I checked a lot of his posts, and this guy is not asking for likes and he's not selling any course. In fact, I even asked him if he would be interested in taking my hypothetical money, and he didn't even reply. So no, this guy isn't selling anything. He's just posting results. Incredible results, actually, again and again. He says he's been pulling in thousands of dollars every month using one single, very mechanical setup at the New York Open. So here is the setup in question. And for most traders, this is the dream. I mean, you get in front of your screen at 9:30 a.m. New York time, you wait for the setup, and in less than an hour, you walk away with 1 or 2 grand. And the best part? He says he executes it the exact same way every single day, and he explains the whole system in details. So I thought, okay, this guy says he has found an edge, and he's showing proof of results. And he's giving it away like that to dozens of thousands of people on Reddit. While that might sound very cool, that also sounded fishy. So naturally, I had to test it myself. Here is the strategy explained in less than 1 minute. Every day at the New York Open, so basically depending on your time zone, you wait for the first 5 minutes of price action to unfold. And then you mark out the low and the high of that 5-minute open price range. Then what you want to see is a breakout of that range with a candle that closes outside of the range and that forms a fair value gap. So as you can see, this candle here closes outside of the range and has formed a fair value gap right there. Once you have that, the candle closing outside of the range and the fair value gap formed, that's your confirmation to enter. So here, since we had the breakout to the downside, we would open a short trade. The stop loss is placed here at the high of the fair value gap sequence. And for the take profit target, if your stop is at a 40 or more points distance, you aim for a 1.5 RR ratio. If, on the other hand, the stop loss distance is less than 40 points, then you would aim for a 2 to 1 RR ratio. So here, the stop loss distance on that trade was 58 points, so we will use a 1.5 R target. If the first trade of the day is a winner, then that's it, you can stop for the day. If, on the other hand, your first trade is not a winner, then you're allowed one more trade for that day. So basically, it's a maximum of 2 trades per trading session. As for the trade management, so the target is a fixed RR ratio, but you're allowed to bring your stop loss to break even when structure has cleared. Now, I get that when structure has cleared can be quite subjective. Basically, that will happen once you've reached at least 2/3 of your TP distance. All right, let's test that. Here is how I've prompted the strategy's rules on Upside. So I wrote, every day at the New York Open, we wait for 5 minutes to mark the high and the low of the 5 minutes open price range. To trigger a trade, either a buy if it happens above the OPR high, or a sell if it happens below the OPR low, we want to see a 1-minute candle that must close outside the OPR and have created a fair value gap. Stop loss at the absolute lowest or highest wick price of the candles that form the fair value gap sequence. TP at 2R if SL distance is below 40 points, otherwise TP at 1.5 R. And if the first trade is a winner, we stop trading for the day. But if the first trade is a loss, we allow one more trade for that day. So far, I want to test it like that, without the stop loss to break even rule, in order to keep things simpler. I basically want to see if there is a real edge here in that 5-minute OPR and the candle close and the fair value gap and so on. All right, so we are backtesting it on MNQ, and we will backtest it since basically August 2025, since this is when that Redditor has started posting about this strategy. We'll use a starting capital of $50,000. That's what you usually get on the regular prop firm account. And we will risk 1% per trade. Okay, the rules are now being analyzed to see if they are clear enough. Supposedly, yes, they are. All right, let's start the backtest. While it's cooking, let me know down in the comments section if you have previously used or seen such a strategy and what you think about it. Okay, the strategy is ready. Let's see the results. All right, over the last 5 months and a half, that was actually really good. Total return was 34% with a max drawdown of only -9%. And if we look at the win rate, 43% with an average RR ratio of 1.66, which makes for a very profitable combination. Therefore, that's why the expectancy is in very positive territory at 0.14. And as you can see, the equity curve over the last 5 months steadily rising. So it's totally understandable why, since that trader has started using this strategy and has started posting about it, he's getting very good results almost consistently. And that trade that I showed you earlier as an example, well, here it is in yellow when I export the trades list. How about we now test it not over the last 5 months and a half, but over the last, let's say, 7 years. So I'll just copy and modify the strategy. We'll keep the same assets, of course, the same logic. We'll just change the backtest dates from, let's say, the 1st of January 2019. Okay, the backtest is ready to go. Let's start it. And while it's cooking, if you like this type of content, make sure you share the video or hit the like button or subscribe to the channel. Oh wow, now the strategy is revealing its true colors. Over a large enough sample of trades, the strategy is actually not profitable at all. If we had traded it over the last 7 years, the win rate would only be 35%, with a reward to risk ratio of 1.69, which makes the expectancy, as you can see, go into negative territory. Therefore, the strategy is mathematically losing. In this overall downtrend, we can, however, see that there are some recovery periods, if we can call them like this, where the strategy actually makes money over a very short time span. And this was the case, as we can see, in the second half of 2024, and it started again in the second half of 2025 right here, and it's still happening as we speak, which is exactly when that Reddit trader has started trading this strategy. His posts on Reddit actually started around here, so no wonder he's been making consistent gains ever since. And this is important because this shows what is called recency bias, where the results you observed very recently might make you believe that these are the results that you should get in theory. But in practice, if you go way beyond what you have observed recently and go far back in the past, then that's how you actually realize that a strategy that has been working well for some time over a long enough period of time will actually not work well at all. So if you were this trader and you've been making money for some time trading this strategy over the last few months, but suddenly you're able to backtest it over the last 7 years and you find this, what would you do? Would you still keep trading it, or how would you adjust things? And by the way, this is what the strategy looks like if we implement the trade management parameters that bring the stop loss to break even. Here you go. It doesn't make any difference at all with trade management or not. Here is how I implemented it. I added bring stop loss to break even once price reached 2/3 of the TP distance. But even with that, it's still almost the exact same equity curve. So the stop loss management brings no edge at all. So what's the takeaway here? It's not that the 5-minute opening range breakout is useless. It's not either that this Reddit trader is lying. And it's definitely not that simple strategies can't work. The real lesson is this: short-term profitability does not equal long-term edge. And this is where most traders get trapped. They discover a strategy during a favorable trading environment. It works for a few weeks, or in this case, a few months. Confidence builds up, position size increases, and then suddenly conditions will shift and the edge will suddenly disappear. Not because the rules change, but because the market did. Edge comes from statistical advantage over large samples and multiple regimes. If you're serious about trading, your job isn't finding what worked last month. Your job is to ask, can this survive multiple environments? Can it withstand years of data? So the next time you see a viral post showing multiple green months in a row, don't ask, how can I copy this? Instead, ask, what does the 7-year equity curve actually look like? And as you can see, this is how, without coding anything, in literally less than 5 minutes, I can test whether an ID or a strategy actually works or not. If this breakdown helped you think more critically about trading strategies, then please share this video or subscribe to the channel. As for me, I'll see you in the next one. Bye.